Trading. It is not just a game of charts and indicators. It is a journey of discipline, patience, and mindset. John F. Carter's Mastering the Trade teaches us that winners in the market are not the ones who have the most knowledge, but the ones who improve themselves every single day. Today we will talk about the final and most powerful chapter where trading becomes not just a skill but a life philosophy. Welcome to the journey of becoming a truly evolved trader. Chapter 1. The Trading Game. In Chapter 1, John Carter first explains the reality of trading. This chapter is written to open the eyes of new traders so they can understand the truth before jumping into the markets. 1. The biggest misconception. Trading is easy. The author explains that when people first see trading, candles moving up and down on a screen, seeing a YouTuber making money, or hearing a friend say, "I made this much today," they start believing that trading is the fastest way to make money. But Carter says, trading looks easy because it's just a few clicks away. But in reality, it is one of the toughest professions in the world. He explains that since anyone can open an account without qualifications, people don't treat it as a serious profession. 2. Trading is a profession, not a hobby. Carter clearly says, to become a doctor, years of study. To become a pilot, strict training. To become a lawyer, continuous hard work. But to become a trader, people simply put money in without learning anything. And this is the biggest mistake. The market is filled with professionals. Your competition is the smartest and fastest minds in the world. If you come unprepared, the outcome is already decided. Loss. 3. The author's own early losses. In Chapter 1, Carter shares his personal journey. He lost a lot of money in the beginning, sometimes even 90% in a single day. Most losses came from overconfidence. He took trades based only on gut feeling, without reading charts. He says that only after suffering losses did he understand that trading is a skill, not luck. 4. The real enemy in trading, you. Carter says the biggest enemy in trading is not the market. It's the trader's own emotions. Greed, fear, impatience. Trading based on hope, revenge trading. The market is always neutral, but your emotions create losses. 5. Why do 90% of traders fail? In this chapter, Carter explains deeply why most people lose money. 1. Starting without learning. 2. Losing emotional balance after a loss. 3. Wrong mindset. 4. Overtrading. 5. Not protecting wins and not cutting losses. 6. No trading plan. 7. No risk management. People trade for excitement, but professionals trade for consistency. 6. The market tests you. Carter says, it's like the market is asking, are you really prepared? Can you stay disciplined? If the trader is not prepared, he quits early, panics after a big loss, and finally leaves the market losing money. But a trader who learns from mistakes survives. 7. The real trading formula, mindset plus skill plus discipline. Chapter 1 keeps emphasizing, the way to beat the market is not a perfect strategy, but perfect behavior. Successful traders control their mind, treat losses as lessons, trust their system, stay consistent, grow slowly and steadily. 8. A warning for beginners. Carter says, if you enter trading thinking it's a joke, the market will teach you a lesson very quickly. The biggest message of this chapter. This is a mental war, not a financial one. 9. The real goal of trading. Carter says no trader wins every trade. The goal is, keep losses small. Let winners run. End the month positive. Follow the system. This is how professional traders operate. Main message of Chapter 1. Checkmark trading is not easy. It's a tough profession. Checkmark. Entering the market unprepared is dangerous. Checkmark emotional control is the foundation of success. Checkmark losses are part of the journey. Checkmark discipline plus planning plus psychology equals victory. Chapter 2. The Trader's Mindset. In Chapter 2, John F. Carter says that the biggest weapon in trading is not strategy, it's mindset. He says, trading is 80% psychology and only 20% technicals. The more stable, disciplined, and emotion-free a trader's mind is, the longer he can survive in the markets. 1. Why is trading psychology most important? Carter explains that the market is an emotional storm. Sometimes greed, sometimes fear, sometimes excitement, sometimes panic. New traders get washed away by these emotions, but a professional rises above them. You don't beat the market with strategy, you beat it by defeating your own psychology. 2. The fight or flight response. The hidden enemy. Carter explains that the human brain works in 2 parts. 1. Logical brain. 2. Emotional brain. Fight or flight response. When prices suddenly fall, the emotional brain activates. It gets scared and says, "Sell now!" But professional traders understand this survival instinct doesn't work in markets. Survival reactions equals losses in trading. 3. Characteristics of a winning mindset. According to Carter, professional traders have patience, discipline, emotional control, wait for the setup attitude, avoid overtrading, accept losses, follow rules. A trader with a winning mindset never takes a trade without a reason. 4. Ego, the biggest enemy. Carter says, ego has no place in the market. Many traders cannot accept loss. They hold losing positions thinking, it will come back up, but that is ego, and it leads to big losses. A professional trader accepts being wrong, exits without emotion, treats loss as a business expense. 5. Trading versus gambling. Mindset makes the difference. Carter says, a gambler relies on luck. A trader relies on probability. A gambler wants excitement. A trader wants consistency. Trading becomes gambling when decisions are not rule-based. 6. Discipline. The identity of a pro trader. Carter gives examples from his life, showing how he skipped many profitable setups just because his system signaled no trade. He says, discipline is boring, but boring disciplines make millions. Every emotional trade is a trap. 7. Fear. The real cause of losses. Fear hurts traders in 2 ways. 1. Fear of entry right pointing arrow good setups missed. 2. Fear during loss right pointing arrow removing stop loss causing bigger damage. Carter says, fear guarantees failure. 8. Greed. The enemy after winning. Greed appears when a trade is in profit and the trader thinks, let's hold for more. But greed traps traders during reversals. A professional. Target equals exit. Rule equals exit. Stop equals stop. 9. Patience. Waiting only for the right setup. New traders want to take trades every 5 minutes, but pros wait only for high probability setups. Carter repeats Mark Douglas. Trading is not about making money, it's about waiting for the right moment. 10. The real battle inside the mind. Markets change daily. Your mind reacts every second, but successful traders control their emotions. Carter says the biggest battle isn't on charts, it's inside the trader. Main message of Chapter 2. Checkmark trading is 80% psychology. Checkmark fear and greed destroy decisions. Checkmark ego turns small losses into big ones. Checkmark discipline makes traders rich. Checkmark pro traders play only A-plus setups. Checkmark right mindset equals long-term profit. Chapter 3. Trading tools. In Chapter 3, Carter explains that to succeed in the markets, a trader needs the right tools, just like a surgeon needs the right instruments. He says, right tools don't guarantee success, but wrong tools guarantee failure. 1. Charting platform. The trader's cockpit. Your charting platform is your market cockpit. Just like a pilot monitors everything from his cockpit, a trader monitors the entire market here. A platform must have high-quality charts, custom indicators, volume analysis, multi-time frame view, market internals, fast execution, no lag, cheap platform right pointing arrow expensive mistakes. 2. The real use of indicators. Carter says, indicators are assistants, not decision makers. Indicators smoothen price action. They don't predict the future, they increase probabilities. His priority indicators: A. Moving averages, trend direction, dynamic support/resistance, momentum shift. He mostly uses 8 EMA, 21 EMA, 34 EMA. B. MACD, trend strength, trend reversal, momentum buildup, essential for his squeeze setup. C. Bollinger Bands plus Keltner channels, the squeeze. Bollinger Bands go inside Keltner channels, right pointing arrow squeeze active. Low volatility, right pointing arrow, big move coming. Markets move from low volatility to high volatility. DADX measures trend strength. Above 20 right pointing arrow trend forming. 30 to 40 right pointing arrow strong trend. Falling right pointing arrow trend weakening. 3. Market internals, the market's real pulse. Market internals show what smart money is doing. He focuses on A. Trin, buying versus selling pressure. Below 1 right pointing arrow buying pressure, above 1 right pointing arrow selling pressure. B. Tick, uptick versus downtick count, plus 800 right pointing arrow strong buying, minus 800 right pointing arrow strong selling. Very important for intraday. C. Advance/decline line, shows market breadth. Good breadth equals strong setup. Weak breadth equals avoid. 4. Time and sales, tape reading, shows real executed orders. Who is buying? Who is selling? At what price? Large orders equals institutional activity. 5. Level 2 data, order book showing buy/sell walls, but may mislead in fast markets. 6. Price action. The king. Carter says, price is the king. Indicators are servants. Price tells which level held, where rejection happened, where buyers are strong, where sellers dominate, where volume spikes. 7. Higher timeframes. Intraday can be deceptive. Higher timeframes show the truth. Weekly right-pointing arrow trend. Daily right-pointing arrow direction. Intraday right-pointing arrow entry. Pros always check higher timeframes first. 8. Scanners and alerts. Don't waste energy searching. Good scanners show volatility squeeze, high volume breakouts, moving average signals, unusual options activity, selective approach right-pointing arrow smart trading. 9. What is a pro setup? 1. Clear trend. 2. Momentum support. 3. Favorable market internals. 4. Volume. 5. High probability entry. 6. Clear exit plan. Entry is small part. Profit comes from setup, plus risk control, plus patience. Main message of Chapter 3. Checkmark right tools equals correct market reading. Checkmark indicators confirm, they don't decide. Checkmark squeeze shows volatility expansion. Checkmark internals show real momentum. Checkmark price action is the pure truth. Checkmark higher timeframes are essential. Checkmark scanners increase efficiency. Chapter 4. Neurology of trading. This chapter explains that trading is not just a mind game, it's a game of brain chemicals. Understanding which emotions become active at what time is essential to avoid costly mistakes. Does the brain win or the money? Only the trader who controls his thoughts, emotions, and brain chemistry wins. Many traders understand charts and strategies, yet their brain's wrong reactions turn a winning trade into a losing one. Fear and greed, the true enemies. 2 chemicals control traders. 1. Dopamine, released when thinking about big profits. The brain ignores risks, causes overtrading, holding without stop loss, taking oversized risk. 2. Cortisol, the stress hormone released during loss, causes cutting stop loss too early, booking profits too early, missing good setups. Beating the market begins with beating your brain. 3 brain mistakes that destroy traders. 1. Loss aversion. Fear of loss makes traders hold losing trades. 2. Confirmation bias. Traders seek information that supports their belief. 3. Overconfidence. After a few wins, the brain says, "You are the king of the market." And destruction begins. Why Carter emphasizes a trading plan? Because a plan controls the brain. Where to enter, where to exit, stop loss, target, risk. If everything is written beforehand, the brain makes fewer mistakes. Remove feelings, bring rules. How professionals control the brain. Checkmark pre-trade breathing. Checkmark journaling, checkmark position sizing. Checkmark daily limits. Key lesson of this chapter. The biggest battle is not with charts, it is with your mind. Bad mood equals bad decisions equals bad trades. Trading is a psychological game. Chapter 5. Your thinking decides your trading fate. A trader's mindset, habits, and behavior determine success. Even with a good strategy, a weak mind repeats the same mistakes. 1. Professional versus amateur trader. Amateur. Excited to get rich fast. Emotional on every move. No plan. Revenge trades. I will hit one big trade mindset. Professional. Calm mind. Risk fixed. No trade without plan. Emotions controlled. Small but consistent profit. Every trade follows system. Carter says, amateurs come to make money. Professionals come to manage risk. That's why money comes to them. 2. Trading equals habit game. Bad habits. Holding losses. Cutting profits early. Revenge trading. Overtrading. Emotional decisions. Jumping at market open. Good habits. Waiting patiently. Always using stop loss. Taking only high-quality trades. Letting winners run. Fixed risk. Change your habits, and the market changes your fate. 3. FOMO. The biggest trap. When the market moves fast, the brain says, enter now, or you'll miss the chance. FOMO shuts down logic. Results. Wrong entry. Wrong stop loss. Panic exit. 4. Discipline. The real capital. Discipline means checkmark trading according to plan. Checkmark leaving screen when rules are broken. Checkmark A+ setups only. Checkmark avoiding trades during emotional highs/lows. Discipline is the bridge between your strategy and your results. 5. Learn to accept losses. Most traders take losses personally, but Carter says, loss equals cost of doing business. Treat loss like an expense, not an insult. If the trade followed rules, right pointing arrow loss is fine. If not right pointing arrow, the mistake is mental. 6. Train yourself like an athlete. A trader should train like an athlete. Focus, patience, mental toughness, energy, sleep, clarity, all impact trading performance. Main lessons of this chapter. Trading is a psychological game. Success comes from strong mind, good habits, and discipline. Adopting a professional mindset equals consistent profits. Chapter 6. First, learn to choose the right setup. Carter says that the market gives thousands of trading opportunities every day, but only a few of them are the ones where the risk is small and the reward is big. These are called high-probability trades. 1. Understanding the market environment. Before taking any setup, it's important to check which phase the market is in. Checkmark trending. The market is moving consistently up or down. Trend-following trades work well here. Checkmark ranging. The market is moving inside a fixed zone. Breakouts usually fail. Reversals work better. Checkmark volatile. Wide ranges. Fast candles. Risk increases. Best to trade with smaller position size. Carter says even the right setup fails in the wrong market phase. 2. 3 conditions of a high-probability setup. According to Carter, a good trade is formed only when these 3 conditions come together. 1. Clean chart structure. A clear trend should be visible. No confusion in price action. Chart should have less noise. 2. Indicator alignment. Indicators are for confirmation, not for creating entries. Indicators must show synergy, alignment. 3. Volume support. Strong moves need strong volume. Breakouts with low volume fail most of the time. 3. John Carter's favorite high-probability setups. John Carter considers the following setups the most reliable. 1. Trend pullback setup. Pullback in the direction of the trend. Reaction at support/resistance. Indicator confirmation. This is his most used setup. 2. Breakout with volume. Price breaks after large consolidation. Strong volume. Must avoid false breakouts. 3. Volatility squeeze setup. His signature setup, explained in detail in the next chapter. But here Carter explains. When Bollinger Bands compress and enter inside Keltner channels, a volatility squeeze forms, meaning the market is preparing for a big move. High-probability setups mean catching the preparation before the move begins. 4. Carter's 4 golden rules for entry. Checkmark Rule 1. Enter only when the setup is fully formed. Entering early equals losses. Checkmark Rule 2. Entry only in the direction of the bigger trend. Against trend trades equals low probability. Checkmark Rule 3. Wait for volume. Enter only when buyers or sellers are visibly active. Checkmark Rule 4. Predefined risk. Stop loss must be fixed before entering. 5. Risk management. With high probability setups, Carter says, no setup is a guarantee. Risk is your real safety. Risk fixed per trade. Stop loss based on structure. Position size based on risk. You can control only risk. Profit is given by the market. 6. Patience equals profit. High probability trades don't come every day. Carter says traders should spend 80% of the time waiting. No trade is also a trade. Waiting is a skill. Patience delivers A+ trades. Main lessons of this chapter. First, identify whether the setup is strong or not. Take only those trades that have strong logic behind them. High probability equals low risk plus big reward. A+ setups equals beginning of consistent profits. Chapter 7. The squeeze setup. A signal of a big move. John Carter says that the market constantly moves between low volatility and high volatility. When volatility decreases, right-pointing arrow price compresses. Right-pointing arrow market becomes quiet. When compression breaks right-pointing arrow, a big move begins. This compression is called the squeeze. The science behind this setup is simple. After calm comes the storm. 1. How to identify the squeeze. This setup is created using 2 indicators. Bollinger Bands, BB, shows volatility. When BB tightens, right-pointing arrow volatility decreases. Keltner Channels, KC, shows the average range of price. Checkmark when Bollinger Bands enter inside Keltner Channels. A squeeze forms, meaning the market is in energy buildup mode. On charts, this appears as red dots as Carter uses. 2. What does the squeeze indicate? John Carter says, price is building pressure for a big move. You enter at the moment when price breaks out of this calm phase. 3. How to know the direction of the squeeze move. This is the biggest challenge. A big move will come, but in which direction? Carter uses the momentum oscillator, TTM indicator. According to him, checkmark momentum upright pointing arrow, breakout usually upside. Checkmark momentum down right pointing arrow, breakdown usually downside. Remember, momentum leads, price follows. 4. Carter's entry strategy, step by step. Step 1, squeeze forms. BB inside KC. Step 2, check momentum direction. Step 3, wait for price breakout/breakdown. Momentum alone isn't enough, need price confirmation. Step 4, volume confirmation. Big moves work only with strong volume. Step 5, stop loss. Structure-based stop loss. Breakout right pointing arrow, recent swing low. Breakdown right pointing arrow, recent swing high. Step 6, position sizing. Quantity based on fixed risk. 5. How are targets set? Carter gives 2 methods. 1. ATR targets. A TR defines how far price usually moves. 2. Momentum exhaustion. When the oscillator shows exhaustion, exit partially or fully. 6. Biggest false signals in the squeeze. Carter warns to avoid. Low volume breakouts. 50% fail. Just before major news. Fake moves occur. Early entries. Entering before the squeeze forms equals mistake. Against trend squeeze trades. Lowest probability trades. 7. The real advantage of the squeeze. Carter says squeeze gives 2 superpowers. Checkmark predictability. You can enter before big moves. Checkmark low risk, high reward. Small stop loss due to compression. Rewards can be 5x, 10x. Main lessons of this chapter. Big profits come from catching big moves. Squeeze equals early signal of a big move. Enter only when momentum plus price confirm. Squeeze equals low risk plus high probability plus high reward. According to Carter, it is his most profitable setup. Chapter 8. 3 time frames equals triple clarity. John Carter says, trend forms on higher time frame, setup forms on middle time frame, and entry on lower time frame. You need all 3 to catch great trades. 1. The triple screen trading approach. Carter recommends this structure. Higher time frame, trend direction. Daily, weekly, defines overall market direction. Trades should follow this trend. Middle time frame, setup formation. 1 hour, 30 minute. This is where squeeze, pullback, breakout setups form. Take only those setups that align with the higher time frame trend. Lower time frame, entry timing, 3 minute, 5 minute. Precise timing. Small stop loss. Avoid early entries. Carter says higher time frame is your eyes, middle is your brain, lower is the trigger. 2. Why is the higher time frame most important? Because it shows the true market strength and direction. Carter says, checkmark, higher time frame never lies. Checkmark free of noise. Checkmark shows big players' activity. Example, if the daily chart is in a strong uptrend, every drop on the lower time frame becomes a buying opportunity. 3. Wrong time frame alignment equals failed trades. Losses happen when higher TF right pointing arrow downtrend, middle TF right pointing arrow range, lower TF right pointing arrow buy. This mismatch traps traders. Carter says if time frames are not aligned, walk away and wait. 4. Squeeze plus multiple time frames equals super combo. Carter's special strategy. Checkmark higher TF right pointing arrow uptrend. Checkmark middle TF right pointing arrow squeeze. Checkmark lower TF right pointing arrow entry trigger. This alignment equals high probability plus explosive move plus low risk. This is his bread and butter strategy. 5. Role of volume and momentum in multi-timeframe analysis. Volume and momentum must align. Checkmark higher TF right pointing arrow positive momentum. Checkmark middle TF right pointing arrow squeeze/setup. Checkmark lower TF right pointing arrow breakout with volume. If volume is missing, the setup weakens. 6. Why amateur traders ignore multi-timeframe analysis. 3 reasons. Impatience. They want quick trades. Confirmation bias. They see only what they want to see. Chart clutter. They think multiple timeframes are complicated. Carter says, it's not complicated. It's essential. 7. True benefits of multi-timeframe analysis. Checkmark eliminates noise. Checkmark gives perfect timing. Checkmark reduces risk. Checkmark helps catch big trends. Checkmark provides confirmation. Checkmark increases consistency. Most important lessons of this chapter. Trading using one time frame is risky. Higher TF equals direction, middle TF equals setup, lower TF equals entry. Alignment equals high probability trade. Multi-timeframe analysis reduces losses and boosts consistency. Chapter 9. You need not 1, but 4 weapons. Carter says, the market keeps changing, so the strategy must also be flexible. This is why he uses 4 main setups like a toolbox. Checkmark 1. Squeeze setup, explosive moves. Checkmark 2. Trend pullback setup, trend following. Checkmark 3. Breakout/breakdown setup, momentum moves. Checkmark 4. Reversal setup, turning points. This chapter explains when each setup works best and when you should completely avoid them. 1. Squeeze is powerful, but not always. Squeeze works well when checkmark compression, checkmark market preparing for a big move, checkmark near news events, checkmark strong momentum. Avoid squeeze when market is already trending strongly, no consolidation, low volume. 2. Pullback setup, safe and stable. Perfect for traders seeking higher accuracy with lower risk. Works when checkmark strong trend, checkmark near moving averages, checkmark retracement in the direction of trend. Fails when checkmark market is sideways, checkmark trend is weak, checkmark pullback shows panic volume. Carter says pullback gives the easiest money if the trend is strong. 3. Breakout setup, fast-moving trades. Works when checkmark large consolidation break, checkmark strong volume, checkmark trend already strong, checkmark momentum aligned. Avoid when low volume, midday near resistance. In common false breakout zones, Carter says take a breakout only when the crowd is actually pushing. 4. Reversal setup, market turning points. Comes rarely, but gives huge rewards. Works when checkmark exhaustion candles, checkmark climax volume, checkmark major support/resistance, checkmark momentum divergence. Avoid when checkmark trend is extremely strong, checkmark no volume or divergence, checkmark based only on intuition. Carter says reversals are low probability, enter only with clear signals. 5. Combining all 4 setups into one ultimate system. Use these steps. Step 1. Higher TF right pointing arrow trend direction. Uptrend right pointing arrow pullback/breakout. Downtrend right pointing arrow breakdown/pullback. Compression right pointing arrow wait for squeeze. Step 2. Middle TF right pointing arrow setup. Squeeze right pointing arrow big move. Pullback right pointing arrow trend follow. Consolidation right pointing arrow breakout. Topping/bottoming right pointing arrow reversal. Step 3. Lower TF right pointing arrow entry. Momentum. Volume. Trigger candle. 6. Carter's rule. Choose the best setup of the day, forget the rest. Mistakes happen when traders take multiple setups in one day. One day equals one pattern equals one direction. This formula gives consistency. Key lessons of this chapter. Market changes. Setups must too. Squeeze, pullback, breakout, reversal each have their time. Higher TF trend plus middle TF setup plus lower TF entry equals perfect combo. Take only the best setup of the day. Quality matters more than quantity. Chapter 10. Trader Psychology, the real key to winning the game. The book says Chapter 10 focuses on the most important yet least understood part of trading, psychology. John Carter says, trading is 80% psychology and only 20% strategy. Meaning, real success in the stock market comes from controlling your mind, discipline, and emotions. Let's understand this in detail. 1. Fear and greed, your real enemies. 2 emotions control every trader. Fear. Fear of loss makes traders exit early. They confuse a retracement with reversal. Result? Small profits, big losses. Greed. Just a little more. By chasing more, traders lose their targets. A reversal wipes out profit. Carter says, you cannot eliminate fear and greed, but you can manage them with rules. 2. Your biggest enemy, your ego. Every trader eventually asks, am I right? But the book says, trying to be right in the market is the biggest mistake. Ego makes traders add to losing positions. Avoid accepting losses. Break discipline. Carter says, your job is not to be right. Your job is to make money. 3. Confidence versus overconfidence. The difference is clear. Checkmark confidence. Follows rules. Stable mindset. Understands the market. Multiply overconfidence. Large lot sizes. No stop loss. Reckless after a winning streak. Carter warns, never increase your size just because you feel unstoppable. 4. Discipline. More important than any trading system. Even the world's best strategy is useless without discipline. Discipline means stop loss on every trade. No breaking rules. Avoid overtrading. No emotional decisions. The book also recommends making a checklist, which is explained in later chapters, and following it strictly. 5. Losing streak. What to do during continuous losses. Every trader goes through bad phases. Carter's method. Checkmark. Reduce position size. Checkmark. Reduce trading frequency. Checkmark. Observe the market. Don't trade. Checkmark. Take emotional rest. Checkmark. Review strategy. Golden rule. When in doubt, stay out. 6. Habits of winning traders. According to Carter, successful traders are prepared, not reactive. Always follow rules. Document mistakes. Observe more than they trade. Stay calm. Most importantly, they never fight the market. 7. Trading journal. The true key to growth. A detailed journal reveals your weaknesses and strengths. What to write. Entry/exit reasons. Emotions. Mistakes. Strategy evaluation. Market conditions. Carter says, your journal is your best trading teacher. 8. Mindset reset. Every trade is a new trade. The book explains, past wins shouldn't affect the next trade. Past losses shouldn't spoil the next decision. Every trade is new and independent. Treat trades as isolated events. 9. Flow state. The zone of peak performance. Carter says professional traders work in a flow state. Calm mind. Clear decisions. Full focus. Balanced emotions. No distractions. This is where best trading decisions are made. 10. Conclusion. Trading is a battle of the mind. Core message of Chapter 10. Beating the market is easy. Beating yourself is hard. This chapter deeply explores emotions, ego, discipline, and mindset. Carter repeatedly emphasizes, trading is a mental game. Strategies help you make money, but psychology helps you keep it. Chapter 11. Futures markets. What a trader must understand. In this chapter, John F. Carter explains the futures world from the ground up. What they are, why they exist, how they work, which contracts are important, and what a trader must pay special attention to. This chapter is very technical, but Carter explains it with simple, real-world logic. Let's understand it in detail. 1. What are futures and why were they created? Carter explains that futures were originally created to lock in prices for the future for farmers, oil companies, airline companies, etc. But today, a large portion of futures is driven by speculation plus hedging. Key point. Futures equals leverage plus liquidity plus volatility, right pointing arrow. This is why traders love this market. 2. Futures trading versus stocks trading. Carter gives a clear comparison. Stocks provide ownership, always carry overnight risk. Lower leverage. Futures. Only price speculation. Very high leverage. 24-hour market. Large trades with small capital. That's why futures mean a small move can make big money, and can lose big money too. 3. How futures contracts work. Carter explains that every futures contract has a fixed structure. Contract size, tick size, and tick value. Expiration months, settlement, cash or physical delivery. Examples: ES, E mini S&P 500, NQE E mini NASDAQ, CL crude oil, GC gold. Each contract has its own behavior. Some are very volatile, some very smooth. 4. Margin, the real power of futures. You don't pay the full amount to trade futures, you only pay margin. There are 2 types of margin. Checkmark initial margin, to open a trade. Checkmark maintenance margin, to hold a trade. Carter warns, high leverage means high responsibility. One small mistake can wipe out your capital. 5. Volatility patterns in futures markets. Carter explains the typical volatility of major futures contracts. Equity index futures, ESNQYM. Follow trends. Violent moves on news. Morning plus closing hours are most active. Commodity futures. Gold, crude, natural gas, soybeans. Fundamental driven. Big swings due to inventory data. Overnight gaps common. Currency futures. 6E, 6J, 6B. Highly sensitive to macro news. More trend clarity. 6. Liquidity. Choosing the wrong contract is a mistake. Carter's big message. Low volume futures equals high slippage equals guaranteed loss. So a trader should choose contracts with high volume, tight bid-ask spread. Examples: ES, most liquid futures contract. Crude oil. Gold. E-mini NASDAQ. 7. Day trading versus swing trading in futures. Carter explains the difference. Day trading futures. Breakouts. Momentum. First 2 hours most profitable. Swing trading. Trend structure. Continuation patterns. Overnight risk managed by volatility stops. 8. Economic reports. The big movers of futures. Carter explains that the futures market is highly news sensitive. Major reports with massive volatility. Non-farm payroll. NFP. CPI. FOMC. EIA. Inventory report. crude, GDP and PMI data. Carter's advice: avoid trading right before news unless you're trained to handle chaos. 9. Futures trend cycles, how the market breathes. Carter explains market cycles. 1. Quiet phase, low volatility. 2. Expansion, breakout begins. 3. Momentum burst, traders jump in. 4. Exhaustion, move overextended. 5. Retracement. 6. Reversal or continuation. Pro traders understand these cycles and enter accordingly. 10. Risk management, the most important part of futures. Carter repeats again and again. Stop loss is mandatory. Keep lot size small. Fix risk per trade, 1 to 2%. No emotional trading. Futures have extremely high risk, so without a plan equals disaster. 11. Which futures contract is right for which trader? Trader type best contracts. Beginners ES, Micro ES, Gold Micro. Fast movers lovers NQ, crude oil. Slow and smooth traders ES bonds. Fundamental players commodities, GC, CL, NG. Carter suggests beginners always start with micro futures. 12. Conclusion. Futures are powerful, but require wisdom. Carter's clear message. Futures are powerful, but extremely dangerous without discipline. High leverage works only when strategy plus psychology are strong. Chapter 11 gives a solid foundation to understand advanced setups ahead. Chapter 12. Identifying the market. Is it a trend or a trap? In this chapter, John F. Carter explains that 70% of a trade's result is decided before entering, when you choose the right market condition. He teaches which market is worth trading, which market is a deadly trap, how to identify trends, how to avoid choppy markets, how to use indicators correctly. Let's understand in detail. 1. Trending market where money is made. Carter says a trending market is your best friend. Trending market characteristics: higher highs plus higher lows, uptrend. Lower highs plus lower lows, downtrend. Breakouts work. Momentum indicators are useful. Pullbacks give entries. In trending markets, risk is lower, reward is higher. Decisions simpler, trade smoother. That's why Carter repeats, trade with the trend. Do not fight it. 2. Choppy market, where money dies. This chapter calls choppy markets the account killer. Choppy market signs: upside breaks fail, downside breaks fail, continuous whipsaw, candles overlapping, moving averages flat. Carter warns, if the market isn't trending, stay out. It's deadly. In choppy markets, stop loss hits repeatedly. Breakouts fail. Mental frustration, overtrading risk. 3. How to identify trend versus chop. Carter's tools. Carter doesn't teach indicator science, he teaches practical usage. His most reliable tools: A21 EMA plus 34 EMA combo. Trend. Gap between EMAs is wide. Both moving in same direction. Price respects EMAs. Chop. EMAs tangled. Flat moving averages. Price repeatedly crossing. BADX indicator, average directional index. Carter calls it the truest trend detector. ADX greater than 25 right pointing arrow strong trend. ADX less than 20 right pointing arrow choppy market. Simple rule: ADX low equals NO trades. ADX rising equals go for it. See price compression, right pointing arrow signal of a big move. Market compression signs: small candles, narrow range, low volatility, EMAs bunching after compression. 1. Strong breakout. 2. A new trend forms. Carter calls this spring loading. 4. Match strategy to market, not market to strategy. Carter explains, in trending markets, right pointing arrow breakouts work. In choppy markets, right pointing arrow mean reversion works. In high volatility, right pointing arrow use small size. In low volatility, right pointing arrow swings are larger. Big lesson: strategy must adapt to the market, not the other way around. 5. When you should not trade at all. Clear no trade zones. When EMAs are flat, ADX less than 20. Before major news. Low volume sessions. Compression with unclear direction. Simple rule: if you're confused, stay out. 6. Best time windows for trading. Carter gives practical rules. Checkmark first 90 minutes of U.S. morning session. Checkmark U.S. closing hour. Multiply. Avoid midday, slow plus choppy. Lesson: trade less, trade smart. 7. Market selection. Don't trade the same contract every day. Analyze 4 to 5 markets daily. ES, NQ, CL, GC. Currencies. Trade the one with rising ADX. EMAs aligned. Clean structure. High liquidity. 8. Conclusion. Learn to read trend and time the market. Chapter 12. Final message. Trending market is a friend. Choppy market is an enemy. Indicators give clues. Market structure gives truth. John Carter's message. Winning traders catch trends. Losing traders fall into traps. Chapter 13. Understand market rhythm and catch big moves. In Chapter 13, Carter introduces the concept that made him famous. The squeeze. But before that, he explains that every market has a rhythm, a heartbeat. This chapter focuses on market's natural rhythm, volatility contraction and expansion, how big moves are created, why the squeeze works, how traders catch momentum. Let's understand deeply. 1. The market doesn't move at once, it breathes. Carter says, the market inhales and exhales. Contraction and expansion are natural cycles. It works like breathing. Contraction equals quiet phase, small candles, low volatility, tight range, indicators compressed, almost no momentum. Expansion equals big move. Volatility rises. Momentum jumps. Breakouts clean. Successful traders identify contraction before expansion. 2. Why most traders miss trends. Because traders enter at random places. They fear entering when trends start. They panic during retracements. They don't understand market structure. Carter says, big money always comes after consolidation. 3. Bollinger Bands plus Keltner channels, the foundation of squeeze. Carter introduces a powerful signal. A squeeze occurs when Bollinger Bands move inside Keltner channels. This is the market saying, wait, I'm loading power. A strong breakout is coming. 4. Why the squeeze works. Because during squeeze, volatility is lowest, risk is minimal, market is quote, compressed. Big players accumulating/distributing, Carter explains it like a spring. A tightly compressed spring must fire. 5. How to catch the direction. Squeeze alone isn't enough. Use checkmark momentum indicators, checkmark price relation to EMAs, checkmark higher time frame trend, checkmark market structure, higher highs/lower lows. Squeeze tells you a move is coming. Structure tells you direction. 6. How market explodes after a squeeze. Once squeeze releases, Bollinger Bands expand, price gives a momentum burst. Volume rises, trend becomes clean, moves may last 1 day, 3 to 5 day legs, sometimes multi-week trends. Carter calls squeeze a moneymaker setup. 7. Mistakes traders commonly make. Carter highlights, multiply, entering too early, multiply, not confirming direction, multiply, ignoring news, multiply, using wide stop loss. He says, squeeze is simple, but discipline is hard. 8. Where squeeze works best. Works great in index futures, stocks, options, commodities, currencies. Best performance in checkmark high volume markets, checkmark strong trend environments, checkmark news supported momentum. 9. Multi-time frame squeeze pro trader's secret. Carter says, bigger the time frame squeeze right pointing arrow, bigger the blast. Examples: 5-minute right pointing arrow, intraday move. 30-minute right pointing arrow, half-day trend. Daily right pointing arrow, multi-day trend. Weekly right pointing arrow, massive swing. Weekly squeezes are mothership signals. 10. Conclusion. Master market rhythm. Chapter 13. Final message. Market compresses, then expands. Compress right pointing arrow squeeze. Expand right pointing arrow trend. Timing equals everything. Carter says, if you can master the squeeze, you can master the market. Chapter 14. Control probabilities, not the market. John Carter explains that a professional trader does not control the market. He controls probabilities. Market is random, but your decisions should not be. Core message. Trading is a game of probabilities, not predictions. Let's break it down. 1. You cannot control the market, but you can control risk. Carter explains, market won't move as you wish. No indicator predicts the future. News is unpredictable. Trader can only control behavior and risk. Professionals take trades that have checkmark clear setup, checkmark small risk, checkmark big reward, checkmark high probability. 2. There is no perfect trade, only a perfect process. Most traders chase perfect entries. Professionals build perfect processes. 1. Setup. 2. Risk. 3. Entry. 4. Exit. 5. Review. This process turns probabilities in your favor. 3. Why most traders lose. Carter's brutal truth. They lose because multiply, no defined risk. Multiply emotion-driven multiply, jumping on every signal. Multiply trading against trend. Multiply, moving stop-loss further. Multiply cutting winners early, holding losers longer. Carter emphasizes, wide stops ruin accounts. 4. The 3 keys that increase probability. Carter formula. 1. Trend alignment. Higher time frame equals trend. Lower time frame equals timing. Same direction equals high probability. 2. Volatility condition. Low volatility, squeeze, right pointing arrow, big move. High volatility, right pointing arrow, chaos. Low volatility plus structure equals best probability. 3. Professional entry timing. Enter when. Market hesitating. Indicators compressed. Volume flat. Big players accumulating/distributing. This is the most powerful zone. 5. Risk-reward ratio, the true weapon. Carter says no system works without proper risk-reward. He recommends checkmark minimum 1 to 3. Risk $1 to make $3. Even if your probability is low, this makes you profitable long-term. 6. Stop loss, most important yet most neglected. Carter says, stop loss is not a suggestion, it is survival. Stop loss must be checkmark, logical checkmark, based on chart structure. Checkmark emotion-proof, checkmark fixed, and non-negotiable. If price hits it right, pointing arrow exit, no questions. 7. Psychology of a professional trader. Carter explains, fear is normal, losses are normal, drawdowns are normal. Emotional trading is the enemy. Overconfidence is deadly. He says, treat trading like a business, not entertainment. 8. Probability thinking equals long-term consistency. Winning traders. Don't judge one trade. Focus on the series of trades. Don't panic on a bad trade. Don't get excited by a big win. Why? Because, over a large sample size, your edge shows up. This mindset creates million-dollar traders. Conclusion of the chapter. Probability is your edge. Chapter 14's main lessons. Market is unpredictable, but behavior can be predictable. Structure plus process plus risk equals winning probability. Trading is a game of probabilities, not predictions. And most importantly, take setups with patience. Exit losers quickly. Let winners grow. Chapter 15. Becoming the master of your mind is becoming the master of the market. In this chapter, John Carter reveals the deepest, most important, and most truthful insight. Trading psychology is more important than your system. In the book, Carter says, charts give you direction, indicators give you timing, but your mind decides your success. This is the reason most traders fail to make consistent profits even after learning strategies. 1. Fear and greed, the 2 biggest enemies of trading. Carter clearly says, fear and greed don't change the market, they change your decisions. Checkmark. What does fear do? You miss good trades. You're afraid to cut even small losses. You hesitate to enter on breakouts. Checkmark. What does greed do? You oversize trades without a reason. You exit winners thinking, let me take a little more. You do revenge trading. These 2 emotions are more powerful than any trend. 2. Why new traders mostly fail in psychology. Carter explains, they think every trade is life-changing. They consider a loss as a personal failure. They attach their identity to a trade. They make impulsive trades out of frustration. They do not respect risk. Carter writes, trading is not personal, it's probabilities. 3. Turn trading from an emotional game into a statistical game. Carter explains that a professional trader thinks like this. 4 to 5 losses out of 10 are acceptable. Every trade is just one outcome. Process is more important. Losses are business expenses. Focus is always on the long term. A perfect trade can still result in a loss, and a bad trade can still give profit. But only a perfect process wins in the long run. 4. Overtrading, the most dangerous habit. Carter calls this the most common mistake. Why does overtrading happen? Boredom. Desire to make money quickly. The urge to recover previous losses. FOMO, fear of missing out. The result of overtrading. Emotional fatigue. Poor decisions. Random entries. Slow death of the account. Carter writes, if you're trading all the time, you're losing. 5. Discipline, the rarest but most powerful skill. Carter explains, take a trade only when a good setup appears. If there is no setup, don't stand in the market. Make rules and follow them. When emotions arise, look at the charts, not your feelings. If a stop loss is placed, don't move it. He says, discipline is doing the right thing even when you don't feel like it. 6. Losing streak, how pros handle it. Every trader faces consecutive losses at some point. But professional traders follow these steps. Checkmark, reduce size. Checkmark, take only high-quality trades. Checkmark, avoid overtrading. Checkmark, trust the system. Checkmark, take a break for a day or 2. Carter says, when in doubt, step out. 7. Winning streak, the most dangerous moment. Success is also a risk because success leads to overconfidence. Carter explains common mistakes during a winning streak: increasing position size, ignoring rules, developing the attitude "I understand the market now." He warns, confidence is good. Overconfidence destroys traders. 8. Trading plan equals your psychological shield. Carter strongly says that every trader must have a simple but strict plan. Checkmark which setups you'll take. Checkmark at what level you'll enter. Checkmark at what level is the stop. Checkmark at what target you'll exit. Checkmark how much size you'll take. Checkmark when you will not take trades. A trading plan replaces your emotions. 9. Meditation, mindfulness, and self-control. Carter explains that successful traders take early morning quiet time. Keep their mind clear. Remove distractions before market open. Maintain emotional neutrality. The quieter the mind right-pointing arrow, the sharper the decision. Psychology is your real edge. Conclusion of this chapter. Setups are not difficult. Everyone can learn indicators. Squeeze is not magic. But, checkmark, controlling your feelings is rare. Checkmark, patience is rare. Checkmark, respecting risk is rare. Checkmark, following rules is rare. Carter says, you don't trade the market, you trade your mind. Chapter 16. The 7 Common Habits of Great Traders. In this chapter, John Carter explains that every successful trader in the world shares certain common habits. Skill, indicators, strategy all come later. Habits and behavior come first. Carter says, trading skills can be learned, but the right habits create long-term success. Here he breaks down those habits that every great trader follows. Habit 1. Early preparation. Preparation is most important. Carter explains that a great trader's day begins before the market opens. Checkmark review of overnight news. Checkmark next day's trend bias. Checkmark which sectors are strong or weak. Checkmark which stocks may give a clean setup. Checkmark major economic events and earnings. Purpose. A clear plan before the market opens. Most traders enter panic mode the moment the market opens. Great traders stay calm and prepared. Habit 2. They trade less, observe more. Carter says, great traders wait more than they trade. Why? Because not every day gives a quality setup. Overtrading ruins everything. Patience becomes the edge. They sit back, observe market psychology, and take entry only when checkmark trend is clear. Checkmark volatility is right. Checkmark setup is perfect. Checkmark risk is small. Habit 3. Small risk, big reward strategy. Carter clearly explains. Small risk, big targets, well-defined stop, asymmetrical trades. This habit separates a trader from a gambler. Great traders know one big loss equals hard work of 10 good trades destroyed. So they decide risk first. Habit 4. They respect losing trades. Carter emphasizes that losing trades are not failure, they are feedback. Great traders stay calm during losses. Review the loss. Improve in the next trade. Do not revenge trade. Reduce position size. Carter says, losing gracefully is a skill. Habit 5. They maintain emotional neutrality. This is a big point. Great traders are fearless but not reckless, are greedless but not passionless. They stay emotionally neutral. Whether the market goes up or down, their mind remains calm. Carter says, emotional neutrality is what separates professional traders from retail traders. Habit 6. Continuous learning. Learning never stops. Carter says, every great trader has one common trait. They keep learning market structure, test new systems, read books, analyze market data, refine their strategies. They are always evolving, never rigid, never ego-driven. The market changes, and great traders change with it. Habit 7. They focus on 1 or 2 setups. Every professional trader builds their identity around a few specialized setups. Carter says, some trade breakouts, some trade trend following, some trade mean reversion, some trade volatility events. Carter himself trades the squeeze. Great traders don't try to become everything traders. They only trade what gives them an edge and what they have tested 1,000 times. This is the key to long-term consistency. Conclusion of the chapter. Greatness isn't a secret, it's a habit. John Carter concludes. Checkmark. Success equals right habits. Checkmark. Failure equals bad habits. Checkmark trading is not a game of skills, it's a game of habits. Checkmark patience, routine, discipline are the real weapons. And his famous line, master the habits, and the trades will master themselves. Chapter 17. The reality of the trading world. Reality of a trader's life. In Chapter 17, John F. Carter shows the real picture of trading, Not the glamorized version, not motivational speeches, but the completely true and practical reality. Main message of this chapter: trading is not an easy path, but with the right expectations, it can become an incredible career. Here, Carter reveals truths every new trader must know. 1. Most traders fail, but why? Carter explains, most people come to make money, but they come without a plan, without discipline, without patience, without proper capital, and with unrealistic expectations. Their first mistake: they think trading is a way to get rich quickly. Carter says, trading is not a get-rich-quick scheme, it's a skill-based profession. 2. The daily life of trading is not as glamorous as it appears. People imagine screens, fast moves, quick profits, luxury lifestyle, but Carter describes the real picture: long hours studying charts, many hours without any trade, isolated work environment, emotional discipline, continuous losses and gains, difficult tests of patience. Great traders celebrate boredom because boredom creates discipline. 3. Capital requirement. You can't play big with small money. Carter says something very true. Checkmark. Small capital equals stress. Checkmark. Stress equals bad decisions. Checkmark. Bad decisions equals losses. He writes, undercapitalization is the biggest silent killer. Meaning, if you don't have capital that keeps your risk manageable, remaining emotionally stable becomes impossible. 4. Income is irregular. This is not a salary job. Carter says, sometimes no big profit for months. Sometimes monthly income comes in a day or two. Sometimes drawdowns last long. Sometimes smooth trending periods occur. This is not a job. This is a performance profession. You must prepare mentally first. 5. Drawdowns, part of every trader's story. Drawdown means a losing phase. Carter explains, even the best traders face drawdowns. Even the strongest systems fail sometimes. Consistency equals ability to survive drawdowns. Professional traders. Checkmark. Reduce position size. Checkmark. Stay mentally neutral. Checkmark. Analyze their mistakes. Checkmark. Strengthen their process. They don't panic. They don't quit. 6. Trading's biggest reward: right pointing arrow freedom. After describing challenges, Carter says, if you learn discipline, control psychology, follow the process, manage the right capital, then trading gives you checkmark time freedom, checkmark location freedom, checkmark stress-free lifestyle after discipline, checkmark unlimited income potential, checkmark no boss, checkmark self-driven career. This is the real attraction of trading. 7. Impact on family and social life. Carter explains that trading is a lonely profession. You spend more time with charts, less with people. Your stress affects your home. Your losses change your mood. Withdrawals reduce social life. Thus he emphasizes checkmark emotional balance, checkmark work-life balance, checkmark trading journaling, checkmark healthy routine. Healthy mind equals healthy trading. 8. Trading is a performance sport. Carter compares trading to tennis, chess, professional gaming, martial arts. Why? Because you need practice. You need mindset. You need routine. You must learn from mistakes. You must constantly improve. Building skill takes time. 9. Conclusion. The real truth of a trading career. John Carter summarizes the chapter. Checkmark trading is not easy. Checkmark, not a path to fast money. Checkmark, it's an emotional roller coaster. Checkmark, without discipline, success is impossible. But if you adopt the right habits, expectations, and process, trading can give you financial freedom. And his powerful final line, trading is simple, but not easy. It rewards discipline, not talent. Chapter 18. How a perfect trading plan is made. In Chapter 18, John F. Carter explains the one thing that forms the backbone of your entire trading career: a structured trading plan. A plan that controls emotions, simplifies decisions, limits risk, creates consistency. Carter writes, your trading plan is your roadmap. Without it, you are trading in the dark. Here he explains step by step how a professional trader builds a plan. 1. What is the purpose of a trading plan? Carter says a trading plan eliminates emotions, stops impulsive decisions, provides clarity, and most importantly, right pointing arrow gives consistency. A plan creates the boundaries that protect you from market volatility. Without a plan equals gambling. With a plan equals a business. 2. First part of the trading plan: market selection. You cannot become an expert in every instrument. Carter suggests checkmark trade only 1 to 3 markets. Examples: S&P futures, NASDAQ futures, crude oil, selected stocks, options on high-volume stocks. Why? Fewer markets, right pointing arrow. More clarity, right pointing arrow. More familiarity, right pointing arrow. More accuracy. 3. Your setup. Which pattern will you trade? Carter says, become a master of one, not an encyclopedia. Write in your trading plan. Checkmark. Which setups will you trade? Examples. The squeeze setup. Trend follow pullback. Breakout with volume. EMA bounce. Each setup must include entry, stop, target, all written. 4. Entry rules. When to enter. Entry rules must be so clear that no confusion remains. Examples. When Bollinger Bands are inside Keltner channels, right pointing arrow squeeze. When histogram turns positive right pointing arrow bullish momentum. When price stays above 21 EMA right pointing arrow trend intact. When breakouts come with volume, Carter says, clear rules plus zero emotion equals good trades. 5. Exit rules. When to exit. There are 2 types of exits. A. Stop loss exit. Stop loss must be fixed, based on technical logic, based on structure, outside swing highs/lows, and most importantly, never widen a stop loss. B. Profit exit. Carter explains, profit exit must always be at logical points. Resistance levels. Volatility expansion. 2R or 3R targets. When momentum slows, profit exit equals test of discipline. 6. Position size. How much will you risk? Carter says, risk management defines your survival. Write in your plan. How much risk per trade? 1 to 2%. Max daily loss? Max weekly loss? Once limit is hit, right pointing arrow, stop trading. This rule protects traders from disasters. 7. Routine. Daily trading schedule. Carter describes a professional routine. Checkmark pre-market prep. Overnight news. Key levels. Strong/weak sectors. Today's bias. Checkmark market hours. Only A-plus setups. No overtrading. Follow the plan. Checkmark post-market review. Journal. Save charts. Note mistakes. Routine creates success. 8. Money management. How will profits grow? A trading plan must include growth logic. Examples. Every 5% account growth right pointing arrow increase size by 10%. Reduce size during losing streak. Monthly consistency test. Carter emphasizes, the goal is to survive and grow slowly. No shortcuts. 9. Psychology rules. How will you control your mind? Carter says your trading plan must also include when to take a break, when to avoid trades, when to stop trading if emotional, what to do during FOMO. Psychology must be written so you can reinforce it. 10. Journal, the real tool of improvement, a powerful component of the plan. Checkmark trading journal. Record every trade. Which setup? Why taken? Entry/exit? What went right? What went wrong? How you felt? Carter says, the journal is the mirror in which you see your growth. Conclusion. Writing is winning. John Carter's essence. Checkmark trading plan equals map of your strategy. Checkmark emotion-free trading equals possible only with a plan. Checkmark consistency equals rules plus discipline. Checkmark growth equals review plus improvements. And most important, write the plan, follow the plan, and grow within the plan. Chapter 19. Advanced Risk Management Strategies. In this chapter, John Carter focuses on the most important skill most traders ignore, advanced techniques of risk management. Carter clearly says, you can never control the market, but you can always control your risk. This is the biggest difference between professionals and amateurs. Your first responsibility, protect your capital. Carter explains that the real game of trading is not making profit, but protecting capital. If capital is safe, every opportunity in the market remains available. Most traders lose because they don't understand. Without capital, there is no comeback. It's not just about stop loss, it's a system of risk per trade. The chapter gives an important formula. Checkmark risk per trade equals 1 to 2% of total capital, meaning, if you have $1,000 right arrow risk, only 10 minus 20 per trade. Carter says this strategy keeps you alive even on bad trading days. Position sizing, the real mantra of winning. Most beginners take too much quantity, and one stop loss destroys them. Carter explains, checkmark, smaller SL right pointing arrow, more quantity. Checkmark, bigger SL right, pointing arrow, less quantity. This math is used by every professional. How to avoid adverse market movement. Carter explains that the market can reverse any time. 2 big protection methods. Checkmark time-based stop. If the trade doesn't move within a certain time, right pointing arrow exit. Checkmark volatility-based stop. Use ATR or Bollinger Bands to avoid chaotic movements. Single trade addiction. The most dangerous trap. Many traders place too much expectation on one trade. Carter warns, never marry a position. Don't fall in love with a trade. Exit as soon as it goes wrong. The market destroys those who keep their ego. Avoid overtrading. Staying calm is a skill. Carter says overtrading is the habit of emotional traders. 2 rules. Checkmark. No more than 2 to 3 trades a day. Checkmark trade only when your pattern is clearly visible. This protects you from fatigue and impulsive trades. Black swan events. How to protect yourself from shocks. Carter gives examples like 9/11 flash crash and explains that big market crashes never come with warning. Safety tools. Hedge positions. Options for protection. Keep smaller size in overnight positions. Diversification. Trailing stop. Protecting your profits smartly. Carter says you can lose even after winning if you don't trail your stop loss. Trailing stop. Checkmark. Move SL upward as profit increases. Checkmark. You exit safely when the trend reverses. This protects your hard-earned gains. Risk to reward ratio. Never trade without it. According to Carter, checkmark minimum RR equals 1 to 2. Risk $1 to gain $2. Following this ratio keeps you profitable even if 60% of your trades are wrong. Conclusion. To become a professional trader, become a risk master. Carter ends the chapter saying, checkmark trading is not about winning big. Checkmark. It is about avoiding big losses. Risk management is the shield that protects both your capital and your mind. Without it, no trading system can survive. Chapter 20. Discipline and Trading Psychology. This chapter is one of the most important chapters of the entire book because John Carter believes that trading is 80% psychology and only 20% strategy. In this chapter, he explains that even a brilliant strategy is useless until a trader has discipline, patience, and mental balance. Now let's go into full detail. The real battle in the market is with your own mind. Carter explains that every trader is fighting 2 types of battles, one with the market and one with their own mind. These 5 emotions hurt traders the most: greed, fear, impatience, anger, overconfidence. According to Carter, if you can control these 5, the market cannot defeat you, any day, anytime, anywhere, in any condition. Trading plan. The future of a trader without a plan is fixed. Carter says the market punishes those without a plan. A proper trading plan includes what setup gives you a trade, what confirmation is required for entry, where the stop loss will be, when and how exit will happen, how much risk to take, what position size to use. Without this, trading becomes nothing more than gambling. Discipline, the real trading advantage. Carter's important rule. Checkmark, never change your strategy. Checkmark, perfect its execution. Most traders change their strategy after 2 to 3 losses. This is where they go wrong. Carter says a trader is identified by their discipline, not their strategy. The art of avoiding impulse trading. Impulse trades are those taken suddenly due to excitement or fear. Carter explains, pause 10 to 15 seconds before every trade. Mentally cross-check your rule checklist. If any rule breaks right pointing arrow, cancel the trade. This technique calms your mind and eliminates impulsive trades. Trading journal. The secret habit of professional traders. Carter strongly emphasizes keeping a trading journal. Write why you entered, why you exited, profit/loss, what emotions you felt, what mistake happened, what to improve next time. Carter says, a journal is the mirror of your trading brain. This journal turns you from amateur right-pointing arrow professional within months. Taking a break during a losing streak. Every trader faces losing streaks. Carter's method. Checkmark. After 3 to 4 consecutive losses, right-pointing arrow. Take a 24 to 48-hour break. Why? Because your mind enters revenge trading. A break resets your mindset and allows you to trade calmly again. Avoid overconfidence during a winning streak. Carter warns. Checkmark. Don't increase risk during winning streaks. Checkmark trade with the same system you use during losses. Overconfidence is what turns good profits into zero. Daily routine. The foundation of a professional trader. Carter says every trader must have a fixed daily routine. 30 minutes preparation before the market opens. Setup scan. Entry rules check. Position size fix. Discipline during the day. Journal writing after the market closes. This routine keeps you focused and calm. Mindset. Treat trading like a business, not a casino. Carter says, professionals think, I will follow the process. Amateurs think, how much will I earn today? Trading is a business. Profit is the byproduct of consistent execution. Conclusion. Control your mind, control the market. Chapter 20's core message is clear. Checkmark. Your real strategy is your mind. Checkmark discipline is the identity of every successful trader. Checkmark control your mind, and the market will handle itself. Carter says if trading psychology becomes strong, even a mediocre strategy can make you consistently profitable. Chapter 21. Advanced Trading Tactics. In this chapter, John Carter explains the techniques and rules that lift a trader from beginner level to professional level. This chapter is especially for traders who already trade but want to improve consistency and precision. Let's understand the entire chapter in detail. Identifying high-probability setups. Carter says all setups are not equal. Some setups have extremely high chances of success. He calls them A-plus grade setups. Identification. Strong trend. Clear consolidation. Volume confirmation. Momentum indicators alignment. Low-risk entry zone. A good trader takes fewer trades but only high-quality setups. Entry timing. The biggest game changer. Entry timing is the hardest but most essential skill. Carter describes two entry timings. Checkmark breakout entry. When price breaks resistance or support, momentum indicators show strength. Checkmark pullback entry. Temporary correction inside a trend. Bounce on trendline or moving average. Pullback entries are more reliable and low risk than breakouts. Multi-timeframe confirmation. Carter's rule. Checkmark. The higher timeframe controls the lower timeframe. Meaning, if higher timeframe is bullish, right? Pointing arrow. Buy setups work better. If higher timeframe is bearish, right? Pointing arrow. Sell setups work better. A good setup. Higher timeframe decides direction. Lower timeframe gives precise entry. This technique reduces bad trades by 40 to 50%. Opening range breakout, ORB, a powerful day trading strategy. This is one of Carter's most famous strategies. How it works. 1. Mark the first 30 minutes high and low. 2. Price breaks above high right pointing arrow buy. 3. Price breaks below low right pointing arrow sell. 4. Stop loss inside the opening range. Big institutions use ORB strategies extensively. Understanding market internals. Candles are not enough. Carter says understanding market internals is the hallmark of a successful trader. Important tools. Tick index right pointing arrow. Strength of buyers versus sellers. Advance/decline line. Right pointing arrow. How many stocks rising? VIX right pointing arrow. Fear indicator. These signals reveal how likely your setup is to succeed. Breakout failure. The most profitable setup. Failed breakouts create the strongest reversals. Identify. Price breaks but volume doesn't support. Momentum divergence. Price quickly reverses. Low risk, high reward. Squeeze strategy. Carter's signature setup. Advanced version. Bollinger Bands contract inside Keltner channel. Low volatility. Explosion into high volatility move. Works brilliantly in swing and intraday trading. Carter says, checkmark. The market pays you the most when it has been quiet the longest. Stops and targets. Advanced rules. Carter advises against extremely tight stop losses. Use logical stops. Below swing, low/high. Outside strong support/resistance. A TR-based dynamic stop. Targets. Previous support/resistance. Fibonacci levels. Momentum weakening. This prevents overstaying and protects profits. Scaling in and scaling out. Signature of a professional. Big traders don't enter full quantity at once. Checkmark. Scaling in. Small quantity when trend begins. Increase quantity after confirmation. Checkmark. Scaling out. Book partial profit. Trail remainder. Risk stays controlled. Reward maximizes. Conclusion. A professional trader is the one who makes fewer mistakes. Chapter 21's essence. Checkmark. Best trades are not huge profit trades. Checkmark best trades are high probability, low risk trades. A trader's improvement is measured by fewer mistakes, better entries, high quality setups. Chapter 22. Building and testing a trading system. John Carter explains that successful traders don't rely on one strategy, they build an entire trading system. A system combines plan, tools, risk, psychology into a machine that produces consistent profits long term. This chapter is crucial for anyone who wants to take trading to a professional level. What is a trading system? A trading system is a mechanical and repeatable process. It includes setup, entry rule, exit rule, stop loss, risk management, position sizing, market conditions, psychology guidelines. The system trades for you without emotions. Why is a system necessary? Carter says, checkmark. Without a system, you are gambling. With a system, you are trading. A system removes emotions, creates faster and clearer decisions, reduces mistakes, increases consistency, keeps risk controlled. Identify your trading personality. Every trader has a style. 1. Scalper. Very fast, small trades. 2. Day trader, intraday momentum. 3. Swing trader, 2 to 10 day trades. Wrong personality, right pointing arrow. Wrong system, right pointing arrow. Continuous losses. How to build a good trading system. Step 1. Choose market and time frame. Indices, stocks, futures, options. Time frames, 5-minute, 15-minute, 1 hour daily. Step 2. Define setup. Squeeze. Momentum breakout. Trend pullback. OARB. Step 3. Entry rules. EMA cross. MACD signal. Momentum confirmation. Volume spike. Breakout. Step 4. Exit rules. Target-based. Trailing stop. Time-based exit. Step 5. Stop-loss rules. Swing low/high. ATR-based. Fixed percent. Structure-based. Step 6. Position sizing. Risk per trade, 1 to 2%. Carter's golden rule. Step 7. Risk management. Max trades per day. Max loss per day per week. No revenge trading. Step 8. Psychology rules. Checklist. No impulsive trades. No emotional trading. Ignore market noise. System testing. The real game. 3 phases. Phase 1. Backtesting. Test on past data. Check. Win rate. Average profit. Average loss. Maximum drawdown. Risk to reward. If it doesn't work on past data, it will never work in real market. Phase 2. Forward testing. Live market without money. Test system in real market without money. Observe how signals appear, how clean entries are, stop-loss behavior. Phase 3. Small capital testing. Trade with small capital for 2 to 3 months. If results are positive, right pointing arrow, scale up. System maintenance. Markets evolve, your system must evolve. Review every 30 to 45 days. Performance. Add new observations. Remove weak components. Adjust to current market. Biggest system mistake. Over-optimization. Trying to make the system perfect makes it useless in real market. This is curve fitting. Good systems are simple, logical, repeatable, scalable. Conclusion. A system makes you professional. Chapter 22's essence. Checkmark successful traders follow a system, not random strategies. Checkmark a system removes emotions. Checkmark testing is the life of the system. Checkmark maintenance keeps it profitable long term. Carter says, your system is your edge. Protect it, refine it, respect it. Chapter 23. Running. Trading like a professional business. This chapter is for those who want to run trading as a full-time career or professional business. Carter explains that to turn trading into a business, you must think, plan, and operate like a successful entrepreneur. Let's understand the chapter in detail. Treat trading like a business, not gambling. Carter says, checkmark. Amateurs trade like gamblers. Professionals trade like business owners. A business requires proper planning, capital allocation, risk budgeting, performance tracking, strategy testing, continuous improvement. Change your mindset first. Set up a trading office/workspace. A serious trader creates a focused, low-distraction environment. Essential. High-quality internet, backup connection, power backup, 2 to 3 monitors, comfortable desk and chair, trading journals and logs. A professional environment creates a disciplined trader. Business capital management. Carter emphasizes, checkmark trading capital equals business capital. Checkmark, never mix it with personal life expenses. 3 accounts. 1. Trading account. 2. Emergency fund. 3. Personal expenses account. This keeps your trading stable and avoids emotional decisions. Monthly and weekly trading plan. Professionals prepare weekly/monthly plans. Which setups to focus on. Allowed number of trades. Risk limit. Market conditions analysis. Review of last week's mistakes. Key improvement points. Planning sharpens your focus. Daily routine of a professional trader. Pre-market routine. Global market check. News scan. Key levels. Setup scanning. During market. Checklist execution. No impulsive trades. Risk rules. Monitoring. Post-market. Journal entry. Chart screenshots. Performance review. Emotional analysis. This routine creates consistency. Taxes and accounting. Record every trade. Entry/exit time. Quantity. Strategy. Profit/loss. Brokerage cost. Mistakes. Improvements. This data helps long-term profitability. Income stability. Don't treat trading like a salary. Carter warns. Checkmark. Trading income fluctuates. Plan your life around variability. Sometimes a lot of money. Sometimes very little. Sometimes nothing. Thus, keep personal expenses low. Save extra money. Don't spend all trading profits. Use extra capital to improve your system. Professional risk control. Golden rules. Checkmark 2% risk per trade. Checkmark daily max loss. Checkmark weekly max loss. Checkmark no emotional trading. Checkmark no trading without your setup. Control risk, and profits will come automatically. Trading review cycle. Professionals review weekly. Best 3 trades. Worst 3 trades. Biggest mistake. Best decision. What to change. What to keep. Next week's focus. Self-review makes you better continuously. Conclusion. Trading is a serious business. Chapter 23's essence. Checkmark trading is not just charts and indicators. Checkmark. It is a complete business system. A professional trader treats trading like a business, protects capital, follows system, learns and evolves. Carter says, treat trading like a business, and it will pay you like a business. Chapter 24. Continuous growth and refining skills in trading. This is the last and most inspiring chapter of Mastering the Trade. In it, John Carter talks about a trader's lifelong journey, a journey that is not limited to charts, indicators, and money, but is built on the foundation of discipline, mindset, habits, and continuous learning. This chapter is extremely important for anyone who wants to make trading a lifelong skill, not a short-term experiment of a few months. Let's understand Chapter 24 in complete detail. Trading is a lifelong learning journey. Carter explains, Checkmark, the market changes. The trader must evolve. The market changes every single day. Sometimes trending, sometimes volatile, sometimes dead, sometimes news-driven. That's why traders must constantly evolve. A successful trader never says, I know everything now. Instead, he always stays in the learning process. Learning is even more important during the winning phase. John Carter says traders usually make the biggest mistakes when they are consistently in profit. During this phase, overconfidence rises. Rules get broken. Risk increases. Discipline weakens. That's why checkmark winning streak is the most dangerous phase for a trader. Even during this time, you must continue following your daily journal, rules, and review process. Turn the losing phase into fuel for growth. Carter explains that loss is never the enemy. Loss is the greatest medium for learning. A professional trader does not panic in a loss. No panic. No revenge trading. Takes a break. Reads the journal. Finds mistakes. Carter says, trading is not about avoiding losses, it is about learning from them. Continuous practice, the secret weapon of every successful trader. Carter explains that reading charts is like learning a language. The more you look at them, the more you understand them. Your continuous practice should include daily chart study, backtesting old trades, testing new strategies, studying market internals, reading journal entries, simulated trading sessions. These habits train your subconscious mind to recognize market patterns and behaviors. Learn from mentors and community. Carter believes that learning trading alone is very difficult. From a mentor or trading community, you get authentic knowledge, practical feedback, new techniques, emotional support, accountability. Learning from the right people multiples your learning speed. Emotional intelligence, the true identity of a super trader. Carter says that in trading, EQ, emotional intelligence, is more important than IQ. High EQ means self-control, patience, resilience, calm attitude, no impulsive decisions. The market gives money to those who remain calm and rise above their emotions. Balance trading with life. A major professional rule. Checkmark, don't let trading consume your life. Carter explains that family time, physical health, exercise, hobbies, social life, rest, all contribute to a trader's mental clarity. A healthy mind right pointing arrow, healthy trading decisions. The real secret of success, consistency. Carter says in this chapter that the most successful trader is not the one who makes huge profit in a single day, but the one who stays consistent throughout the year and earns small, stable profits. Consistency comes from daily routine, discipline, one system approach, review and improvement, control over emotions. Consistency equals long-term wealth. Never be overconfident. You are always a student. Carter ends with this very important message. Checkmark, you are always one trade away from humility. The market can defeat anyone at any time. So always, stay grounded. Follow rules. Drop your ego. Keep learning. This mindset is the foundation of a great trader. Final message. Trading is a journey, not a destination. The conclusion of Chapter 24 is deeply inspiring. Checkmark trading is not a game of money. It is a game of character. Checkmark, never stop learning. Checkmark, Discipline is your superpower. Checkmark mindset is your real capital. Checkmark review, practice, and patience are your real growth engines. In John Carter's words, become a student of the market, because the market rewards the learner, not the gambler. Trading has no finish line. It is a journey of continuous growth. Every day, every chart, every trade teaches you something new. Remember, the market keeps changing, and only the trader who never stops learning gets the chance to win in the long run. Maintain discipline, continue practicing, and make yourself a little better each day than you were yesterday. This is how you master the trade, and this is how you become the trader you were meant to be. Thanks for watching Reading. Keep learning, keep evolving, and keep winning.